the 2-10s spread. So we may have heard this before. You might have heard about it throughout 2022. It's quite a big thing in the financial markets. And what is it? So the news you would have heard, of course, is the 2-10s spread inverting. And then that becomes a question then. What does it mean for the markets and for the economy? So I'll just put some notes, and of course you can screenshot that if you wish to. So 2-10 spread is literally the difference yield. You can also do 2s 30s, 2s 5s, 5s 10s, 10s 30s. But what you tend to want to do is having the lower maturity. So you look at it like at the example I talked about, 2s 10s, 5s 10s, whatever, 10s 30s. You could have 1s 2s. So the difference between the 1 maturity and the 2 maturity. So think about it, the lower, the more, so there's more importance it has in a way, if you want to look at it from there. So 2s 10s is the difference between the 2-year yield and the 10-year yield. So what does it mean? So I'll show us, of course, a live example in just a moment. But essentially what it is an indicator, i.e. if you see it invert, so if it inverts, there is a recession. So there's no sort of time frame as to when a recession means, but it means fairly close. And when I mean close, I'm not talking about a couple of weeks. Of course, as a fundamentalist, you have to think much long term. It inverted in 2022, around, I believe it was around the middle of 2022, and we're only getting towards that middle period now. So it has not been a recession in the US yet, but it typically indicates in the future that there is going to be a recession. When it is, it doesn't tell you, but that's why you follow up to date with the data. How's the GDP doing? How's the employment market doing? How is, the underlying factors, for example, like the retail sales and the data that would suggest how is consumer confidence, etc. The data would suggest how are people feeling, and that in itself can tell you if a recession is imminent. So if it inverts, it tends to mean that there's a recession on the way. Of course, if it's positive, means the economy, which means interest rates are likely soon. Of course, because if the economy is expanding, that means inflation is likely to be moving higher as well. And as we know, the central bank wants to fight that as early and as swiftly as they can. So as we see, if it inverts, it tends to mean that there's recessions on the way. There's no sort of time frame, it's going to happen in 3, 6, 12 months. But, it just typically gives them an indicator that a recession is on the way. And of course, like I said, you just keep up to date with the data just to, understand when that may happen. Keep up to date with the employment data, the data that would suggest spending from consumers, because as we know, if people tend to spend less, then something is definitely happening there. Interest rates are probably biting their pockets, and that slows down that growth, and then that just brings forth the worries of a recession. And of course, if it's positive, it typically means that the economy is expanding. But like we know, throughout 2022 or the middle of 22, roughly when it inverted, off the top of my head, we'll look at the exact time it inverted. But off the top of my head, it was roughly the middle of 2022. It doesn't mean though, if it is an inverted yield curve, for example, like we know the 2-year yield is higher than the 10-year yield, or the 5-year yield is higher than the 10-year yield, that's still an inverted curve. We saw still economic expansion within the US, but like we said here, it typically means that there's recession on the way. Whenever it happens, it's dependent on the data, of course, and that's what, as a trader, you must keep up to date with. But like we know, just that's sort of a rule of thumb, if you will. Like we know, it's not exactly 100% correlation in regards to an indicator, right? It's a useful, but it's not exactly 100%. Because obviously, as we know, other factors can obviously affect bond yields. So bond yields can be influenced, shall we say, by other stuff such as, geopolitical events. So I'll just put global events and global economic conditions, which of course can tell back into that global event sort of story. So that's the sort of view you see it as. 2-10 spreads, of course, difference between the 2-year yield and the 10-year yield. You can also, like I said, have a 1-2 spread, a 2s5 spread, 5s 10s, 10s 30s, etc. Lower the maturity first in the spread. So if you're looking, you think, I wonder what the inversion of between the 10 and the 5s, you think, okay, I need to look at the 5s first and then look at the 10, and that will tell me if it's inverted or not. It's an indicator of economic stability and a sort of holistic view. And of course, if it inverts, it means that there's a recession on the way, or is likely on the way. And if it's positive, it typically means the economy is expanding, which means interest rates are likely to be risen soon. And as we know, bond yields can be influenced by other stuff, such as the global events and global economic conditions as well. So just keep up to date on that front. So what does this mean for a currency? So like we know, if 2s 10 spread is moving higher, that typically means interest rates are being risen. It's obviously affected by monetary policy. So let me add monetary policy into this. I'll put a comma actually, comma, and monetary policy. So it's typically also affected by monetary policy. So we saw this throughout 2020, early 2022, of course in 2023 as well. We saw that occur, and that's because the Fed was raising rates. As we know, if the bond yields climb higher, as you learned in the Applying Bonds to FX video, if you haven't watched that, please go back and watch it. Like we know, if interest rates are being risen, typically investors tend to demand higher yield on the bond, of course, because naturally it becomes a bit more riskier. Although, treasuries and bonds are said to be, fairly safe, there's always that risk, and obviously investors demand higher yield naturally, of course. So that's the kind of viewpoint on the way that the sort of curve moves. And what does that mean for FX? So let's just get up then the US 2-year. So US 02Y, enter. US 2-year yield. Let's have a brief look at what's going on here. So we then click up in here on trading view, then type US 10-year. So it's already going up up here for me already. Just type US 10 and then Y at the end. Click it, and then it will come up. So let's just put these both as lines, just so it's a bit easier on the eye. So as we can see, it's inverted at the moment. So when did it invert? Let's have a brief look. So it first inverted. So of course the 2-year yield is this line here, and the 10-year yield is this sort of orangey line here. So what we see is roughly at June, July time when that inverted, and then we saw all that news about recession. But like we know, the reason why it inverted is because the Fed was raising rates. So it's generally fairly positive, to be fair, if it does start to invert, because we understand that interest rates are being risen, and that is generally pretty positive for the currency. However, you must also consider the data. So, for example, applying bonds to FX video, we spoke about the BOE and the UK. Obviously, they were raising interest rates, but the data was terrible, so the currency weakened. This is the kind of thing you have to think about as well when you're talking about an inversion yield curve, because we understand, it gives that reasoning as to, well, it's like an indicator, right? It's just an extra confirmation just to look at. But if you're thinking, if you know, without even looking at the yield curve, that the Fed is raising rates, then you would typically expect it, or even at the pace that they have already, you would expect it to be fairly close in regards to the spread between them both. And whether it inverts or not, you'd have to, of course, look at the data and the actual sort of figure here on the right. So, of course, this is the 2-year yield up here, and that's the 10. As you can see, at the moment, it's inverted. So this 2-year is higher than this. However, we start to see this close the gap. So, of course, I've done a video on what that means. That's just a Bull steepener. So essentially, the 2-year yield is closing the gap to that longer maturity. So that just typically means it's negative for the currency, because the reason it would move down is because of what potential the Fed may do in regards to its policy. And as we know, the reason it's being driven higher is mainly because monetary policy, and the reason it's moving high is because the Fed's raising rates. I was expected to continue to raise rates, but then it flattens out, or it steepens, shall we say. It typically indicates that maybe the Fed may have to begin to cut rates, and that, as we know, is not a good thing for the currency. And that's why we've seen that weaker dollar since here all the way down. Although the Fed is still expected to raise rates, it's because the markets are believing in the understanding that data is really starting to turn, and the US is going to go into recession, which means cutting from the monetary policy. And that's why we did see that dollar drive to the downside. So this is the typical how you would use it. I mean, like I said, it's just another additional to your toolbox. Use it as sort of an indication of potential recession. You can look at the 5. So let's have a look at the 5-year yield. USO 5Y against the 10-year yield. So the 10-year yield is here. As we can see, 10. And then this one up here is a... but as we can see, the 5-year yield is inverted technically in comparison to the 2-year yield, but it's actually followed pretty closely with each other for, for basically all the way back since February 2022, closely linked with each other. So it typically just means that maybe, if we do start to see it or uninvert, shall we say, we are going to see some sort of potential cutting sometime soon, of course. And that's, as we say, we just keep up to date with the rhetoric of the Fed or the central bank that you're looking at. Keep up to date with the data, the labor market data, the inflationary data. That would all tell you if the Fed is going to cut sooner rather than later. And as a result, you'd think, okay, well, we know it's inverted at the moment, but it just means that at some point it's going to uninvert now because cutting is going to happen relatively soon. So that's what you use it as, and that, of course, from this view on, so basically from this view on, you'd have a negative stance on the currency. From this view on, you'd have a fairly positive, given the data is relatively strong as well in the economy. So this is the way you'd view it as. So I'll draw it like this. So this means stronger currency. This means weaker currency. So like we know, if bond yields are climbing, that typically is good for the currency and vice versa. So that's the sort of viewpoint you have to have. And how long you know it's going to invert or uninvert is, of course, going to be up to the data. That's pretty much it. You just follow the sort of rhetoric of the data. If it indicates that cut's going to happen, then you would expect it to continue to uninvert and then eventually become a positive yield curve again, which is negative for the currency at that sort of period, of course. And that's when, again, we understand, I've done a video on the sort of bond, different type of bond curves. So like the bull steepeners, the bear flatteners, what that means for currencies. But like we know, for example, this, so if I put, just very briefly talk about it, that would be called a bear flattener. That would be called a bear flattener as that inversion happens. A bull steepener is when this sort of thing happening as of right now, whereby that 2-year yield is just falling faster than that 10-year yield. But I've done another video on that, so you can watch that in your own time. That is the inversion of the yield curve. We'll also just compare this very briefly whilst we're here to the US dollar. So if I just get up DXY on this side, DXY, and just compare it. So of course, look at the dotted line. So what's that on the daily as well? We'll both put it on the high time frame, 3-day, and we'll put this on a 3-day as well. So as we can see, yields starting to drive higher, drive higher, drive higher, drive higher. Look at the dotted line, drive higher. Dollar still drove higher, inverted further, inverted here, although it is pulling back. Remember, as we know with bonds, it's not always a one-to-one correlation in that regard, but it gives you a fairly decent view of the currency going forward, given that the data is still strong. So always think, okay, well, this suggests this, but is data supporting it? That's what you sort of framework you work with. It drove higher, 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 higher. Yield started to stall, right? So did the dollar. It then collapsed. Yield started to climb lower, climb lower, climb lower, climb lower, climb lower. We then saw that re-hawkishness from the data. Data suggested that further hikes are going to happen. Investors demanded higher premiums on the bonds, of course, because more risk, more rates are being, rates are being risen further. And then we saw it begin to bull steepen, which then suggested dollar weakness. So that's the way I would use it. I'll just use it as a sort of gauge. Okay, we are starting to see that. But I use it more in the terms of bull steepeners, bear flatteners, etc. But I've done a video on that, so you can go back and watch that. And that should make a bit more sense with what I'm speaking about. But that is it on the inversion, the 2's10 spread. Simply, very, very briefly, it's essentially just a holistic view of essentially the spread between the 2's and the 10's. You can, like I said, you can look at the 5's, 10's, 10's, 30's, 20's, 30's, etc. That just gives you a sort of view on the maturity. As we know, if it inverts, that typically means a stronger currency, because it would only invert because, or it's likely to invert most of the time because of monetary policy. And that means hawkishness, which is generally positive for the currency, given the data is still strong. However, if it begins to uninvert, if we will, that typically means, rates are expected to be cut soon, which is negative for the currency. So that is it on the 2's10 spread. I'll see you in the next one.